Hello, everyone, and welcome to another episode of the Let's Talk podcast. My name is Demetris. This is my co-host, Akim. And today, the episode today is about Akim's strategy and portfolio. Last episode was about mine. It was about my strategy and my portfolio. We went through it position by position. Today will be the same thing about Akim. Hey, buddy, how's it going?
Hey, Dimitri, doing great. How about you?
Very well. I'm very well. I'm so excited to talk to you about this because even though we talk every day, multiple times a day, we text each other about the markets and about the developments and about all that. Sometimes we skip because we know each other so well. And when I see something going on sale, I'm assuming you're buying it, and I'm sure that you think the same thing about me. But let's give the audience an insight to you. Like your copies are going to watch this, and they want to know what is your strategy and how you go about it. So, just to sum it up, what is exactly is your strategy? How do you go about it? How do you select? When do you decide when to buy or when to sell? Which I know they are very complex questions.
Yeah, look, I'm gonna do a little bit of psychology because
Yeah.
honestly speaking, I didn't prepare this episode, so I don't know where we're gonna go, and I don't even know what I'm gonna say 1 minute from now. But what I know is that when you're an investor, as an investor, you reflect your personality. Is your personality is reflected as an investor. That's why psychology of investing is really important. You first need to understand who you are as a person to be able to understand your biases and to understand also your strategy and your expectations. So why I refer to psychology is because me as a person, and Dimitri, you know me as a person, I'm someone rather quiet. Quiet not in the sense that doesn't speak much, quiet in the sense of emotionally quiet, not someone who's gonna suddenly yell or burst in cries, or right, someone rather calm. And this is how I like my portfolio to be: calm and at the same time growing, developing, growing, calm. So those are words that you can use actually about me. And when you see the portfolio of someone, for example, your portfolio, Dimitri, we did it in the last episode. It's an episode it's a portfolio that is rather ambitious, that is volatile, right, to some extent, that moves a lot. And this reflects also your personality. You're someone who has, inherent movement inside yourself and ambition. And in the case of my portfolio, it's really important to understand that I focus on calm assets. Not necessarily calm assets per se as individually calm assets, but as a whole, it should be calm. So I have crypto in my portfolio. Cryptos are not calm assets, it's even the opposite. But together, combined with some other assets that I have, such as US Treasury bonds, 20 plus year duration, the combination of those with appropriate weightings make the portfolio be calm, right? And another thing to know about me, and this you already know me, Dimitri, about this, is I have no taboos. So I can speak about absolutely anything in this world, and I can speak my mind the way I think that I actually think. And same with my strategy. I have absolutely no taboos when it comes to financial instruments. I can invest in stocks, ETFs, cryptos, currencies, commodities, whatever. I don't use leverage because using leverage is money that is not mine. And this is really important for me not to use leverage, just to be clear. So no taboos by using my money, so no leverage. And I think we will have a look at the portfolio. But again, no taboos. And the most important is that it's a portfolio that grows over time. I have time. I'm also very patient as a person. And I have time. My time horizon is maybe 80 years. I mean, I feel I'm gonna live till I'm 100, or even I don't know, I could die tomorrow. But the way I live and feel that I live is that it feels like I'm gonna live over 100. And this is how I invest, is that when I invest, I want to be sure that I'm not going to lose any of my past returns and that I'm going to continue accumulate and compound returns over the years, even when there are market downturns, even in difficult years where there are market downturns, because I have no taboos on financial instruments, I'm going to use the right financial instruments. Even if I have to short some stocks, I can short as well, as long as I preserve that path of double-digit returns. It's a low double-digit returns, but this is my target. Between 10 and 20% return, right? Probably more between 10 and 15% per year.
So double-digit return is better than the historic S&P. The S&P, I believe, is 9.8 for the last 100 years. And if you invested for the S&P, you basically made a lot of money. The question is consistency and how long-term is your long-term view. And recently you became a father. So now you're not just investing for your lifetime, you're investing for the lifetime on someone else as well. So if it was long-term before that, now it's extra long-term, correct?
Now it's extra long term, and
Extra long-term.
I am even looking at the 22nd century already to
22nd
pick
century.
to pick the sectors. It's funny you mentioned that because just this morning I was writing. I love to write in my free time, and this morning I was writing a piece of article. It's going to be published soon on my blog, and I will maybe publish it elsewhere. I was writing about cybersecurity. Cybersecurity is not a sector that I'm very familiar with. I am not really a tech guy, professionally speaking. Professionally speaking, I'm a portfolio manager, and I do work with tech companies and tech-related investments, but it's not my natural field of expertise. But today I was researching cybersecurity, and I was writing about cybersecurity. And cybersecurity is one of the sectors that you're going to need the entire 21st century and the next centuries as well, because we're going into that digital era, and it's basically the defense, it's basically the military of the digital military, right? The online army, that's cybersecurity. And we have armies since thousands of years, right? And we're going to continue having defense, the notion of defense, of protecting maybe your nation, your company, your family, or yourself. We're going to have that notion of defense for centuries. And that's why I think that we will switch somewhat from defense stocks, traditional military stocks, to cybersecurity stocks. It may well go hand in hand as well, but I don't see a major boost in traditional defense like we're going to have in cybersecurity. Cybersecurity is very recent, is a new sector. I saw the biggest stock, it's Palo Alto, and it has something like 100 billion of market cap. 100 billion only. This is not even the market cap of AT&T. It's 1/10. It's not even 1/10. It's 1/30th of Nvidia, 1/30th of Apple. So and I'm very sure that there will be cybersecurity stocks that will be in the trillion market caps in the next years. And I went a little bit off course, but this was to answer your question about my views. And I have this very long-term views when I invest in a portfolio, and I resonate in sectors more than in specific stocks, even though I pick specific stocks, but I don't keep them for my entire life. The stocks, I'm not holding them for my entire life. What I hold for my lifetime is sectors.
Yes, because and this is my belief, and I'm sure you agree as well, the portfolio is like a living, breathing thing. It has to evolve. You start it, you might gonna have your portfolio for the next 50 years, but in the meantime, some companies are gonna come and some companies are gonna go, and hopefully as a good investor, you can recognize which one should be included and which one should be excluded. But the point I want to make, is it like, because I am like that too, I wasn't even looking at the cybersecurity stocks until the CrowdStrike debacle. So when that happens, and then you start, okay, let me look into those to see what they're all about. And then you start with the price to
Mhm,
earnings ratio, and it's ridiculous. But then you dig a little bit deeper, and you see
mhm,
they are really good companies, correct?
mhm. Yes. To be honest, I had exposure to the cybersecurity sector before the fiasco.
Yeah.
It's a real fiasco what happened with CrowdStrike. The entire globe basically was shut down. This, by the way, tells us of the importance already today of cybersecurity. One update, one software update of one company can cause Microsoft to go nuts and a lot of companies out there to shut down for a day, airlines, banks, hospitals to not be working for a day, right? And this tells us about the importance of cybersecurity. But I was invested already in the sector before that through the ETF, Cyber, CIBR, uh,
Mm-hmm.
ticker name, because I didn't know how to pick a specific stock because they all look pretty expensive and they all look pretty good, to be honest. Now I made my picks. It's Cloudflare. So I sold the ETF Cyber and I decided to invest in Cloudflare a few weeks ago. It was also before the fiasco of CrowdStrike. And in a few weeks, maybe this week even, but I think probably next week, I'm gonna add Fortinet, which is another cybersecurity stock,
Mm-hmm.
and I will hold those stocks as long as they keep growing and the fundamentals are good. And what I was saying in terms of my strategy is that I invest in sectors. So there are sectors that I will hold for my life, that I will hold forever. Cybersecurity, blockchain. So there are a couple of sectors like that are high growth and that I will hold forever. Also AI, as long as the theme stays alive. But again, I'm not a tech guru. I don't have that much knowledge when it comes to tech and software. I'm not a programmer, I'm not a developer, I'm not a software engineer, and I'm aware of my limitations here. So I will always be careful. I'm not going to go 100% into tech, even though I think that is going to be the sector that will continue to outperform in the future. Uh, I try to mitigate the tech risk because when there's a market downturn, when the market falls 20%, tech falls 40%.
Yes.
The beta is extremely high. So I diversify with other sectors that are much more stable and where the earnings are stable for the sectors. And then I look in those sectors and I choose companies that have earnings that are stable or growing, ideally growing, and ideally with an accelerating growth. And the entire portfolio moves overall not very much, but I have most of my days are green, but little green. And this is my aim, is to be growing every day, slowly every day. You cannot see it, but I have a lot of plants around me. Maybe I can show a lot of plants around me, all over the all over the room. Uh, this is how I see my farm. Sorry, this is how I see my portfolio. I also have aquariums where I have a lot of plants. This is how I see my portfolio. I want it to be green and growing slowly, steadily, but growing. You
Yeah. All right. So show us the. Let's take a look. That's what people want to
Let
see.
me let me do a little screen share.
The
So
screen
for those who cannot who cannot see the video because they're listening to the podcast, it's not dramatic. We will describe it.
No, we're gonna describe it and they're gonna get the picture.
Yeah.
Okay.
Very
Okay.
well.
So listen, I'm just gonna comment on it because you're showing your performance through from 2022 to 2024, which is 3 straight green years, which is probably one of the few that managed to have a green year in 2022. I know I didn't. So that's quite the track record.
Mhm. Yeah, I mean, I will not brag about it because I'm sure that if I start bragging about it, I'm sure that I'm gonna have a red year because the markets
Right?
have this talent. The markets have this talent of
Yes.
interpreting and relaying karma. And if you start being overconfident, and again, this comes back to psychology from the beginning of the episode, we mentioned psychology of investing. This it's important to stay humble, to
Yes,
stay cautious, because as soon as you feel a bit too confident, the markets will remind you that you need to stay humble,
yes,
and you need to always be cautious. And when I say cautious, it's not when a stock price drops you sell, right? You believe in the stock and the stock has good fundamentals, you hold. I'm just saying, don't go and do crazy stuff. Buy GameStop with leverage.
yes,
This is an extreme case, but there are different kinds of risks, milder risks that people don't see as risks. For example, everyone is buying a stock and is going crazy online, and it's a stock that may have fundamentals. I say, do your own research, Don't
yes,
buy it just because your friend said it or your neighbor, because they have different portfolios and it may not match your portfolio,
yeah,
because maybe you already have a lot of tech stocks and you don't need to add another one, right? And the way I so if we look at the stats, actually,
that, yeah.
I just want to bring attention a little bit to people. eToro is a great platform and you have detailed stats and is really useful. But there are a couple of things, I wouldn't call them bugs, but look, 14 trades per week. This means that I do 2 trades per day.
It sounds like a day
That's
trader.
that's practically the frequency of a day trader. I'm
Yes,
sorry, I'm absolutely not a day trader. What happens is, let's say I have a position of $1,000
yeah,
in one stock, right? $1,000.
mhm,
What I like to do, I prefer, instead of having one position of $1,000, to have 100 position of $10, or 20 positions of $50. This allows me to change the weightings
mhm,
very easily, right? I can sell an individual position, or as the stock rises, I can sell one by one, right? I have different take profit targets. And if I was invested in one stock with one position, this would divide the number by by at least 14. It would look like I have one trade per week.
yeah,
I probably don't even have one trade per week. Maybe I have one or two per month, where I adjust some allocations. So this is something that I really wanted to bring to the attention of people. Now, looking at my portfolio. All right.
all right.
Now looking at, yeah, I opened my portfolio. I know, Dimitri, if you wanted to ask something specific about it.
So so let's start with, because it's not very typical. Your portfolio is not very typical. It's not like the average portfolio you're gonna open. You're gonna see the Nvidias and the
Mm,
Microsoft and the Amazons and the Teslas. Bam, 16% of your value is bonds. Is the TLT, is the long, is the 20-year
mm,
20-year treasury bond ETF. It's like, I mean, uh, most people
yeah,
probably wondering, how did you even get 11% return this year with the weight of the treasury bond that high? So explain why do you have that? Because I'm guessing
Go
that
ahead.
you didn't have that
Tell
position
us your guess.
3 years ago when you started.
So I will tell you everything about TLT. It's a position I'm often asked about. Um, so first of all, my portfolio is a 70-20-10. 70-20-10. It's not an 80-20 or 60-40. Those are known terminologies, where 60-40 is 60% stocks, 40% bonds. 80-20, 80% stocks, 20% bonds. I have a 70-20-10. 70% stocks, 20% bonds, So right now is about 17%,
Mhm.
but I will increase it a little bit. It will be around 20. It's not the exact science, it moves every day. 20% bonds, and 10% is actually opportunistic trades. 10%, I don't want to use the word junk because it scares people, but 10% is basically a lot of junk. When I say junk, it's good junk, it's not bad junk. I'm not buying GameStop. I'm shorting GameStop
Yes.
with those 10%. I'm shorting meme stocks. I'm using those 10% to do, let's say, a bit riskier trades, right? For example, I have Platinum in my watch list. I will enter it probably very soon. I'm just waiting for the right moment. Platinum is something that I like to swing trade because the price trades always in a range. So I usually don't go short with it, but once it reaches some kind of bottom, I buy it and then it goes up again. So Platinum enters that 10%. Crypto enters also that 10%. I call it I call it junk, but it's my way to say risk assets, right?
Yeah.
For some people, it's absolutely not junk. And the cryptos that I choose have real fundamentals, actually. Hedera and Cardano. It's probably the two altcoins with the best technologies, together with Solana. Solana got a little bit expensive, and Ethereum. But those two are probably among the best altcoins from a technological perspective, right? So those I include in the 10%. Together, it's not even 5%, it's around 5%, Hedera and Cardano. It's very volatile, so it moves a lot. In one day, it can be plus 30% and then minus 30%. It's extremely volatile. And so I included in that 10%. And I bought them because we are in that Bitcoin cycle where it's expected that Bitcoin will rise a lot by next year, right? But in essentially, what goes into that 10%, and I focus a lot on that 10% because it's a big return enhancer. It's probably what gives me the most return. At least it gives me the most beta. That 10%, very risky 10%. The reason I call it opportunistic trades is because I'm not using fundamentals or traditional metrics to evaluate certain assets. You cannot use price to earnings to buy Platinum. You cannot use the dividend yield to buy Cardano or Hedera, right? You cannot use the revenue growth to decide to short GameStop. Well, you kind of can use it. But anyway, this 10% is a bit exotic trades, let's say exotic trades, right? And in that 70-20-10, I have 20 is bonds. I might increase it even beyond 20. I will see how it goes. But basically, this ETF.
Is it the only bond ETF you have, or you have another one?
So when I say 20 bond, I also mean bond-like assets. And bond-like assets, I include stocks like Verizon.
Verizon, yeah.
Verizon is a stock. Verizon is a stock, but it pays a 6 and something percent dividend yield, and the stock doesn't move much, right? It stays flat for a while, and it's mostly fixed income investors that buy Verizon. So in that 20, I include also bond-like assets, which include some stocks like Verizon. I had AT&T last year, and it's stocks that pay dividends. I have Mercedes. Mercedes has an 8% dividend yield. So in that 20, this is what enters the category. And TLT, I might increase it even a bit because this ETF, I will not spend too much time on it because it can get very technical, but basically TLT rises when interest rates in the US go down. And the Fed will cut rates. There is no doubt about it. The question, of course, is when, but I don't care when. I have time. Even if it's in 3 years, I have time. But they will cut at the end of this year. They will cut in next year, probably. This is the highest probability. I mean, it's practically 100% sure that there will be cuts next year. And TLT will rise. This is a certainty. And this is what I like to have in that 20 part of the portfolio is that certainty of income and of capital growth, right? And for TLT, I will have 3% dividend yield, and it will grow. It's a certainty when interest rates come down.
It has an inverse correlation to the interest rates. So as the Fed cuts, it should go up, and as the Fed raises, it goes down. And you got it somewhere at the top of the hiking cycle, correct?
Absolutely. I bought it at, I mean, I think it's the optimal price. I
Yeah.
bought it now with the interest rate at 5.25 to 5.5%. I waited until I got the signal from Jay Powell that they done raising rates, and I bought it, and I'm going to buy a bit more of it because for me there is really no single doubt in my head that the rate will go down, the interest rates will go down
Okay.
later this year or next year. And then once the Fed is done cutting rates, I will sell completely TLT and reallocate to other bond-like assets. I will see at the time what pays the best dividends, or yeah, I will see at the time how to allocate it, but that 20 will stay there.
So I'm guessing, and I'm just guessing now, but you like to have some bond-like asset in your portfolio to perform like an anchor in case something crazy happens, because after that you have Google and you have Microsoft, and
Yeah,
those two usually they move together, and
yes.
take the move all together up or down. So you want something to hold your portfolio together just in case something crazy happens.
I see my portfolio as a ship, as a
Yeah,
big ship on the ocean, like a cruise ship, right? On a sunny day. But sometimes you have storms and you have winds and you have rains, and you need to be able to throw an anchor.
yeah.
Otherwise, the ship will go down. And it's really important when you have a portfolio for the long term where you're just cruising around the oceans to have that anchor. And that 20 is an anchor, and the number is not random. It's the double of 10, and 10 is the proportion of risk trades that I
Yeah.
take. So for every unit of risk that I take, I have two anchors for every unit of risk, right? So 10% risk, 20% safe haven, and then 70%. This is this is probably my specialty, the 70%. I'm a portfolio manager, and in my daily life, I analyze companies. This is what I do. I analyze their financials, I analyze their products, their pipeline management, whether it's a good or bad fit for a certain fund's portfolio, right? This is basically the job of a portfolio manager. To manage risk and at the same time be able to analyze a lot of companies and select companies. And in that 70, I have a bunch of companies that are somewhat unrelated, because they're from different sectors. And I'm invested in the US, in different European countries, in China. So also no taboos when it comes to geography. I invest what I think is best, but at the same time growing, uh, that have earnings growth, right, over time.
So I see there you have some typical that you will see, some typical position that you will see in probably anyone's portfolio, the Google and the Microsoft on the top. But then you have some other ones
Yeah.
that they are not so well known. And
Yeah.
for example, you have Humana in the healthcare
Mhm.
sector. What is that about?
Yeah. So for that 70, I make a list of sectors and I try to think what sector, like the weighting of every sector.
Mhm,
And there is the healthcare slash pharma sector that I think is really important
mhm,
because you have a lot of old people. People are getting older,
Mhm.
and the demographics are getting older in the world, especially in developed economies like the US. And I have Pfizer and I have Humana. Both stocks are different. Both companies are very different. They're not competitors at all. Pfizer and Humana. Pfizer is pharma. It's about medications, vaccines, etc. And Humana is a healthcare provider. A lot of Europeans don't exactly understand how the healthcare sector works in the US, because in Europe it's mostly public, the healthcare sector. You have some private ones, but the private are seen more as complementary to the public. While in the US, you most likely are going to have a private service provider unless you are extremely poor or uh, or or very old and poor.
Mhm.
Then you enroll respectively in Medicaid or Medicare. But in the US, you have big healthcare providers like UNH, Humana, and I think there's a real case for them, for those stocks and for that sector to continue growing, because you have people getting older, and this year it's an election year, and we know Democrats, they always want to expand healthcare coverage to Americans. This we know, Obamacare, etc. Interestingly, Republicans also this time, because of J.D. Vance, the VP pick of Trump, he wants to bring healthcare into rural America, right? Rural America is actually the main, is the core of the voters of the Trump Vance ticket, and he wants they want to expand healthcare also deep into rural USA. And I think this is going to benefit big players like UNH, like Humana. And Humana is a big bet of mine. UNH, I missed the train. You managed to catch it, and you
I did.
significantly increase your exposure in UNH. But UNH is in my watch list. And next time there's a drop, depends if I have cash at that time, because I don't like to hold much cash. If I have cash at that time, I will add UNH. I didn't have cash at that time to be deployed in UNH, because I prefer not to sell a stock out of hurry to buy another.
Yeah, that's a
It's
mistake.
something that
Yeah,
takes time for me to decide.
I try to
And
avoid.
UNH dropped,
I
but it
try to
rose
avoid
very
that as well.
quickly.
I try to avoid
Yes.
that as well, to sell something to buy something else. And sometimes the opportunity comes and you don't have the cash. And other times you have the cash, but there's no opportunity to buy. So
Yeah.
you have to manage to hold your impulses and not sell something to buy something else. But going back to no taboos, I mean,
Yeah.
you have BlackRock, you have
I have
Alibaba,
BlackRock,
which by the
Alibaba, I
way,
have
you are the first
Zijin Mining, I have Meituan, C Limited,
you
right?
are the first
Go ahead.
you are the first portfolio I'm seeing anybody of being in green in Alibaba. Everyone got killed in Alibaba. The board and they're like 40% down.
Yes,
You are the only one
yes.
with a 3% profit on Alibaba. But you have Alibaba, you have Pfizer, you have BlackRock, okay. You have Lockheed Martin, some military industrial complex. You have
Look, let's
Petrobras.
go quickly through every stock. I give one
Yeah,
sentence why I have every stock. Google, I think they're gonna catch up on AI. They were late, they're gonna catch up on AI. They have all the data and they know how to interpret the data. That's why I have it. Microsoft, the cloud business, Azure is amazing, is growing very quickly. That's why I have it. So those two, yeah, it bothers me a bit that they are so famous and so well known, because if they were smaller companies, I would buy them for sure as well. I didn't buy them because they're big. But I think it's important to have some Max 7 exposure. Atlassian Corp, this, I don't know if you know that. Do you know that company?
I'm not familiar with that one.
even you don't know it, which means a lot because you know 90% of the publicly listed assets, and it's one of my biggest positions when it comes to stocks. This is the next Microsoft. I'm not gonna say anything more than that. It's a software company, is great, it's growing fast. It's been one of the few that has been growing its earnings in the last 5 years, double-digit growth, and will continue to grow in the next 5 years, double-digit growth also. Mark my words, this is a big one.
Okay,
This is
okay.
my strongest conviction.
I'm writing down. I'm writing down that one. Okay.
Is this one, Atlassian Corp. BlackRock collects fees from transactions that it helps to arrange and to to finance. And
ETFs.
with interest rates going down next year, interest rates go down next year, valuations will go up of companies, private equity, of startup, of whatever you want. And because valuations will go up, BlackRock will collect more fees, their revenue will grow. As simple as that.
But yeah, it's an interesting mix. It's an interesting mix. It's definitely a safe portfolio if you look at, because even though you have big tech, you don't have the crazy big tech. You don't have the Nvidias and the Teslas in there. You have the profitable, less volatile like tech.
Yeah, look, Nvidia, for me, is not crazy tech. It's it became crazy because of the hype, but the
Yeah,
company itself is a good company, and it's growing steadily. And so Nvidia, it's something that I would add in my portfolio at some point. The I'm just waiting for a better stock price. If it never comes, a better stock price, it's fine for me.
yeah.
But I'm waiting for a better stock price. A better stock price, I think it's under $100. Now it's trading around 120. It's not that much. Nvidia, it happened already that it had weekly drops of
You can get it in
20%.
a couple of days. If something goes wrong, you can get it in a couple of days under 100.
Uh, Absolutely. If some rumors or whatever, you can get it in under 100. So I have cash ready for Nvidia. Tesla, unfortunately, yes, that one is a little crazy to me because of the CEO, Elon Musk. Uh, the reason is that I cannot assess the risk of Tesla. As you know, for me, risk management is the most important thing here in my portfolio because I want to grow it steadily and have this 70-20-10. The thing is, Tesla, I don't know where it would fit because it's a stock, so technically it would fit in the 70. But at the same time, it's so risky that it would fit also in the 10. And at the same time, it's something completely different from GameStop and completely different from Microsoft that it doesn't even fit in the 70 or in the 10. So I would need to create a separate category just for the Elon Musk companies,
Elon Musk
just
company,
for
yeah.
because Elon Musk is so different, let's just say different from all the other CEOs that my mind is a bit too square to be able to assess what weighting I would even have for Tesla.
Mm.
If I put Tesla in this portfolio, I don't know even what weighting I should put on it. Should I put it in the basement? Should it be a top stock? It could be either in the top stock or the thing is Tesla, if I'm not mistaken, is the stock that's the most bought by eToro users. So this I also have in mind. Tesla and Nvidia, both of them. I have that constantly in mind. I have this portfolio, I have this fund basically that I invite people to, invest in and copy. Um, for me, it's not so relevant to have Tesla because everyone has it already. Same with Nvidia. So I'm thinking for the copiers, it's not a real value add because when you check the portfolios of the copiers, a lot of them already have Tesla, already have Bitcoin. So those two, I say, no need to add them to this portfolio. I want to bring people to, different kind of uh, assets that they wouldn't even think of adding in their portfolios, right?
Yeah, that's a good point. That's a good point that a lot of people already own it. And I'm sure losing 40% of its value in a single month Yeah,
That's tough.
that's tough.
That's tough. And it's the kind of stocks I want to avoid. One that loses 40% in a month. Because of what? What reasons?
I mean, it was 2022, and it was the bear market, and it was like the end of the year. And
Yeah.
I was holding the stock, and it was like the third or fourth largest position in my portfolio at the time, and lost 40% in December of 2022. I was outperforming the S&P by 2%, and then I ended up underperforming by 5% because of Tesla.
Mm,
But that's what you get. But in some years, you get a good performance. So based
yeah.
on what you have here, I don't think it fits in your portfolio, at least now on the top. Maybe in the basement, if you want to put it to add some color between Verizon and the other Chinese company to have
The
like
thing is, I don't even know how to value. We should make a separate episode about Tesla, but I don't even know how to value Tesla because if it's a car company, it's completely overvalued. If it's a Is it a tech? Is it an AI company? Is it a robotics company? It's none of this. It's Elon Musk valuation. It's an
yes,
Elon Musk premium or whatever you
yes.
want to call it. And I don't have that in my textbook how to properly value Elon Musk companies. I just don't have it. It's more about gut feelings, I think, the way you invest in Tesla and see where people stand, because when you look at traditional metrics, yeah,
Um,
I like
that
traditional
doesn't make
metrics.
any sense. When you look at traditional metrics, that doesn't make any sense.
It doesn't, and if it did, Warren Buffett would be invested in Tesla, but you don't really, you cannot picture Warren Buffett investing in
I
Tesla,
mean, to be
right?
honest, Warren Buffett wasn't invested in Google, Microsoft, other than Apple. He's not invested in the other big technology companies that gave us the returns in the last decade or two. So you
Yeah.
cannot go by that completely. But he's an older investor and he understands different companies better. So it doesn't necessarily mean those companies aren't good enough for Buffett.
But for him, what's important is the relationship with management. I
Yes.
think this is his main focus, his quality of management. Elon Musk has quality, there's no doubt about it. But it's his relationship with management and CEOs. And Elon Musk is the kind of guy, if Warren Buffett calls Elon Musk, okay, example, Warren Buffett calls Bill Gates and says, "Hey, Bill, look, maybe that dividend, maybe you increase a little bit that dividend for next year." And Bill is gonna be, very diplomatic. Even if he wants to say no, he's gonna be diplomatic. And right, the thing, if the same happens, Buffett calls Elon Musk, says, "Elon Musk, it's been a while. You didn't pay any dividends to me. I'm a shareholder. To your shareholders, you didn't pay." Elon Musk is just gonna say, "You can fuck off if you want," right? and
Go with yourself.
and and I didn't want to say it at the time, but you said it, and I think it's the that's a little bit the issue with
Yes.
Elon Musk, is that it's not a CEO that as a shareholder you feel really at rest with. He's unpredictable, anything can happen.
Yes.
So
That's the
if
risk.
you like spicy, it's nice to have it in the portfolio, but yeah.
If you like boring, it's not gonna. And sometimes in our conversations, we we talk and we say, how would you describe this company if it was food, if it was a cuisine? Sometimes we
Yes,
compare it with food. Yeah, Tesla is definitely spicy.
that's
It
what comes to mind.
yes,
Something spicy, very spicy.
it's very spicy, and you have to like it, that kind of food for you to try it. If you never tried it, it's better not trying it on a Saturday
Yeah.
night in a fancy restaurant in New York City. It's not going to end up well. You're going to be running home
If
uh,
you want to try it at home in
at
very
home.
small
Yes,
dose.
yes,
And I might do it in my private portfolio in small dose. I don't even own it in my private portfolio, which has very different assets from here. But I might try in my private portfolio in very small dose at home alone, not telling anyone.
Yeah, but with other people's money,
Yeah.
if it's not your cup of tea, then it's not your cup of tea.
I stay away and I will stay away. I rarely say forever. And we start the episode saying I have no taboos. Turns out that I have probably one taboo is Tesla.
When when we get Elon Musk on the podcast, and you will talk to him one on one, then you're gonna see Tesla differently.
He
That's
might change my mind, yes.
yeah,
He
you
might change my mind
change
if
your
we
mind.
talk. Or maybe not. Maybe he will confirm me in my opinion. All right.
All
Thank you,
right,
Dimitri.
that was a good explanation. Thank you so much for going one by one and again uh, and explaining because for you it's more like a collection of assets. It's a collection. It's a collection of sectors, and the sectors have different assets, and they all meld together, and they create a 3-year green portfolio, double-digit return. In the end,
Yes, it's
it doesn't matter how you get there. Just get there. Just get to the 3 years double-digit return, right?
3-year double-digit return, and if I want to have 100-year double-digit return, that's the goal.
That's the goal.
It's extremely ambitious. People say, "Oh, you have such low target, 10, 15%. What you gonna do with that?" I say, guys, almost nobody, not even 1% of all the investors that have ever existed reached double digits return every year over the long term. And that's a very ambitious role. So
Yeah,
yes, I don't have plus 30, plus 40%, but the ones who have plus 30, plus 40, they have or surely will have minus 20, minus 25 or
yeah,
more
that happens.
downturns, right? And that's just, that's just how it is. And I'm focused on double digits returns. And yeah, my portfolio is a bit like a Lego. So, you can easily assemble, disassemble it. And that's what I do. I assemble, disassemble, add weightings to certain sectors. And I don't like to buy ETFs. I think I can do better than ETFs. ETFs just buy everything from one sector. I think I can choose the best company or companies of every sector, and that's what I do.
Awesome. Awesome.
All right. Thank you, Dimitri.
A nice conclusion. Thank you for going and explaining in this stock marathon today about your portfolio. And thanks to the people that are watching or listening to our episode. They're gonna love those insights, those couple of companies that I was even knowing a couple of them. So you dig deep in there to find them. Companies for me not to know them. I'm usually aware of the
Yes,
company.
absolutely. All right.
All
Thank
right.
you. Then have a good day.
Have a good day, everyone, and see you on the next one.
Bye bye.
Bye.